What's up, everyone? Riz here. Thought I'd put together a little video after the rough couple weeks that we've had in the market. And I know there's a lot of people out there that are uncertain. Maybe they're feeling down, they're feeling fearful or afraid or nervous, anxious, a whole bunch of words you can identify with, I'm sure. And you know what? It's okay. It's not just you or you're not the only one going through it. All of us, no matter how long we've been doing this for, are always a little bit anxious when it comes to market environments like we are in now. So what I'm going to do is I'm going to break down what's going on, what to keep an eye on, to kind of calm your nerves. Also make some comparisons to a similar kind of drop that we had, hint hint 2020. And then I'm going to provide some insights on what you should potentially consider doing. Again, this isn't financial advice. I'm not telling you what to do, but these things that I sort of am essentially implementing myself, and I'm just sharing them with you, and you can consider them if it's suitable for you. So let's flip over to the chart, and I'll do a breakdown and give you my thoughts.
Okay, so you can see my screen here. I have the TradingView platform up with the S&P 500 index, and just a quick recap, I have the 50-day moving average and the 200-day moving average here. The 50 is the green line, and the 200 is the red line. Uh, what you'll also see is these arrows. These arrows, the red one specifically, the most recent one here is actually my Alpha Cross Evo indicator that my students get access to. And you can see on, what was this, January 18th, it gave a short signal, essentially a bearish signal. Doesn't mean you got to go and short the market or anything like that, but it gave a bearish signal. And this is something a lot of us in the elite membership and, of course, other students also saw and were paying attention to, especially after this big red candle here. So we can see from a technical standpoint that this wasn't unexpected, at least not for me and our elite members and, of course, our students. But most importantly, why is this happening? Why are we seeing this drop in the market? And to kind of demystify that, I thought I'd put together this video, and you can see here that I have key levels, and I had these drawn beforehand, especially from some of the weekly webinars that we do for elite members, and you can see the 4,700 area followed by the 4650, and then the 4,600 and 4,550, and then the 4450, 4,400, and lastly the 4,300 levels that are drawn here in white lines respectively. Why have I had these levels? Well, for many reasons, either support key levels, areas where I feel like buyers could potentially come in, so they're acting like support. And of course, in a bearish way, if they break through, if the stock, or sorry, the index market breaks below, that can spell more trouble and more of a decline. And that's exactly what's happened. As we've broken through the key levels, I've kept people in the elite membership updated, but also I provided updates across my social media platforms, and hopefully you benefited from that as well to keep an eye on. So as we crack below these key levels, 46, 44, 45, 50, and then of course a big drop today and yesterday. And these 2 days, yesterday, Thursday, January 20th, and today, Friday, January 21st, really are the ones that caught a lot of people off guard, in a sense that we had a lot of intraday volatility, especially yesterday on Thursday. And you know what? We had a green day, and then it just completely sold off and completely reversed course in the afternoon. And with Friday, we had a continuation of that. And guess what? We've broken below that 200-day moving average, and it's not a pretty picture. It's not a good situation. In fact, this is this week has been the worst week in markets since March 2020, and it doesn't take a genius to recall what March 2020 was, which was the last big sell-off had begun due to the coronavirus pandemic. So I'm not saying that we're due for that kind of drop. I'm not saying that we're going to see that kind of price action or that kind of bleed out. But this wasn't unexpected to the extent that I let my elite members know, especially others who were paying attention, that we need to build cash and we need to secure profits sooner and we need to be patient because there's a lot of opportunities out there. And we've been doing that. So I've highlighted three key takeaways for you to kind of work on and sort of plan out as per your individual positions and individual style. Again, this doesn't apply to investments, something that you plan on holding for years. This applies to trades, swing trading specifically. But let's move on to as to why we're seeing this. We're seeing this drop for a few reasons. We know that inflation is around 7%. This is obviously one of the highest annualized inflation metrics for the last, I think, 20, 30 years at least. So that does not bode well, especially after the Fed said they're going to have it under control and it's transitory and yada, yada. Obviously, I've been saying for at least 6 to 8 months now that the Fed is behind the curve. They need to act. They may not like it. It may not be the easiest thing to do, or it may be something that, has its own negatives, but they needed to do it sooner rather than later. And we are here in the beginning of 2022, and they've signaled that they're looking to do at least 3 rate hikes. And the market is actually of the mind that perhaps it could be 4 rate hikes. And that doesn't please the market, obviously, because when rates go up, it becomes more expensive for companies and individuals to borrow. And a lot of these growth stocks that have had a massive run in 2020 and all the way up until the beginning of this year, or even last year, where we started seeing some cracks in growth stocks and tech companies, well, that's been a big 180. The easy money has been made. Now the real traders, now the real seasoned veterans, the experienced professionals, those with market staying power come into their own. And I've always said, you know what, I make some of the most money during times like these. And that was true in 2020. And so far, I mean, we don't know where the floor is. I've highlighted some of these areas for you, but wherever the floor is, wherever the market eventually finds an area to settle and start recovering from, the team and I will be there to take advantage. And to me, I look at these kinds of price drops and market drops as, think of it like opportunities. I look at them in a positive light. Yeah, I'm not happy, if my portfolio is down from all-time highs, or it's been a large drawdown day, or there's been a day where my holdings are down, the portfolio is down. It's not easy. It's not fun. It's not something that I get happy about. But on the other side, I'm not upset. I'm not necessarily panicking. I haven't sold anything in a panic. I've been holding because the things I hold, I'm comfortable holding during bull markets and bear markets. And I'm not saying that this is a bear market. I'm not saying this is a crash. In fact, to give you an idea where we are off of all-time highs, we're approximately right now just about 8.5% off of all-time highs. So the moment we get to a 10% mark from highs, that is officially a correction, right? A crash is 20, 30% from the high. So we're not there yet. I'm not saying that's going to happen, okay? So for all those people that keep thinking either we have a straight to the moon or crash, that's not how markets work. The reality is somewhere in between, and it's kind of like a pendulum. The pendulum swings from bullishness to bearishness based on broader, not only technicals, but also macro related occurrences, right? So we've seen rate hikes as being something that's giving the market a little bit of hesitancy. That it's giving the market some pause for concern to reevaluate. And what's that's happening in tech, it's already been happening, and it's happening broadly across pretty much all stocks, which are correcting to account for rate hikes. And if we're assuming 4 rate hikes in 2022, each of 25 basis points, so we're looking at benchmark rates going probably up about 2%. And of course, that's going to have a trickle-on effect to everything, from mortgage rates to line of credits to loans, car loans, personal loans, and of course, borrowing costs across the board for these companies as well. So the market is thinking, well, look, it gets more expensive to borrow. Growth stocks, these tech stocks, are very much reliant on borrowing money to fuel growth. Hence, we need to discount them, That's why we're seeing these big drops. Like we've seen Amazon, even though it's a money printing machine, it's one of the most amazing companies in the world. Um, that too has been sold off. So nothing is safe, really. Nothing is safe. We've seen massive, haircuts in Netflix, down 20% in a day. In total, it's down about 40% from the high. This is Netflix here, right? It is a growth stock. It's a tech company, but still, it's reliant on cheap rates. It's reliant on easy access to capital to fund its growth. And so are many other companies, right? There's so many great companies out there that have been sold off. And I'm not yet ready to say, okay, hey, these are the companies I think you should consider. I'm not at that point yet, but when I am, I will share that with you all. But for now, I recommend these 3 points to keep an eye on. Take profits on trades if you have them. If you have positions that are in the red and they're solid companies, good companies, you have a thesis, you believe in it, and there's nothing necessarily wrong with the trade, then it's okay to carry. Um, and last but not least, you want to try and build a cash position. You want to try and increase the cash position in your account, either by taking some profits or by adding capital into your account, because this is where the opportunity is. The opportunity is made in the waiting. The opportunity is when coming in and not just buying anything and everything that's fallen, but being strategic and buying, in a very calculating manner at certain intervals, certain points. And that's where you can really see a good ROI. Again, you have to do your due diligence. You have to have the right training and guidance, and that's up to you. But really, I thought I'd do a little bit of a breakdown on markets, interest rates, and what it's kind of doing to broader tech sector. But again, the entire U.S. stock market and even the global markets as a whole, because we are in a rising rate environment, and the rate hikes need to happen. People are probably wondering, well, everyone's bleeding, and rate hikes will make the cost of borrowing go up. So why are they doing it? Well, because that's the only way you cool down the economy. That's the only way you cool down inflation, which is running red hot. And inflation at 7% annualized is not good, because if we have runway inflation, we get massive, increase in inflation. Will just keep going. It will just keep going and eroding the value of our money, the U.S. dollar or Canadian dollar, or whatever currency, right? So it's very important to have that in control. It's unfortunate the Fed has been asleep at the wheel, but hey, it goes to show you can be the federal chair of the U.S. Federal Reserve. You can be, a leader of a political party or a country, and you can still be a dimwit, right? So this is unfortunate. But hey, it is what it is. At least they're looking to react sooner rather than not at all. I mean, at least the blindfolds come off now rather than being blind forever. So it is what it is. And that's why we are seeing a normalization in markets. This is completely healthy. This is okay. Do not fall into the trap of being fearful and panic and get depressed or anything like that just because this is happening. This is completely normal. In fact, I welcome these kinds of opportunities because guess what? It means that the markets, it means that companies and the economy and really life as a whole is becoming normalized. It's massive amounts of money printing, massive amounts of handouts, massive amounts of speculation, and everything going up and up crazy is not normal. It's got to stop sometime. And the sooner it stops, the better, because if it goes out of control, a lot of people get hurt. And we've seen that, aka 2008. Where massive amounts of hysteria, speculation, and loose monetary policy and regulations can get you. And before that was 2000, 2001, the dot-com bust. So again, there's very different situations, and there's going to be a lot of people, calling for crashes and, drawing fear and trying to, make money off of crazy headlines. Don't fall for that. Keep an eye on markets. Be prudent. Be strategic. And of course, remain calm and follow the 3 steps if you can, if it applies to you. And you know what? If you have any questions, absolutely feel free to reach out. I will do the best I can to assist in any way that I can. And it's been awesome to get a chance to hopefully share my thoughts with you. And if you enjoyed it, please like the video, subscribe, comment. It helps a lot, especially in this day and age where there's so much noise, so much misinformation, and so much nonsense out there. So I hope you enjoyed this video. Thanks a lot. Cheers.